Okay. Let's begin. What I intend to do today and next week is this. I am going to, we are actually at the section of legal entity and corporate governance. I'm going to finish this today, and then we begin just by looking at a sample joint venture agreement. This one, let me pass this by. I think it's good to actually have a glimpse of what a joint venture agreement looks like. This one is good because it's short. It has Korean translation and also have a little bit of a simple commentary designed to be used by a small and medium-sized companies who cannot perhaps afford lawyers to draft agreement. So that is a form which they kind of created to help. But I think it's helpful because once you know the basic structure, I think you can handle more complicated one as situations arise. Right? Okay. Oh, my tummy. It's going strange. It's intense level of sugars that I have. This level of sugar, I haven't had this level of sugar for many years. It's doing something. Okay. Now let's take a look at the question again. 2 point. Is it 2.9? 2.9. What are the duties and responsibilities of director, including representative director? Is there any legal distinction between executive directors and non-executive directors? Could a director be appointed for the position of another senior officer at the same time? Does the director, other than the representative director, have the power and authority to legally bind the company when dealing with a bona fide third party acting in good faith? Wow, what a question. Well, let's begin with the last question. Do you think not but it should be does a director가 돼야 되겠죠, right? Does a director other than the representative director, right, have the power and authority to legally bind the company when dealing with a bona fide third party? What's a bona fide third party? That's right. Bona fide is genuine, bona fide in good faith, meaning that, that third party does not try to trick you, but, intentionally in good faith believes that you are you have the authority to represent the company. But do they have the legal power and authority to legally bind? As a director, what do you think? Okay. What do you think? Who has the legal power to represent the company? The RD. That's why his name is, his title is representative director. He has, by his position, legal title and right, and power and authority, statutory, to represent the company. And how can a director who is not the representative director represent the company then? How? Exactly. By a authority delegated, right, by the representative director. For example, through a power of attorney, 위임장, right? I can delegate to this guy to represent it, you know. So that is a typical way of doing so. Outside of that, a director does not, by in and of itself, just because he's a director or he or she is a director, do not have the authority to bind the company. So when a director signs it, for example, and then later on the company denies it, he's a mere director. He's not the representative director. He doesn't have the power to bind it, right? What happens? Probably not, you know. It depends on the situation, but it is most likely in the absence of special circumstances, well, the director is presumed to be not having a legal right to represent the company, right? Okay. Could a director be appointed for the position of another senior officer at the same time? Yeah, sure. Director here means the registered director, the member of the board of directors, right? Okay, sure. You can have the title of CFO, for example, right? Chief Financial Officer, but at the same time, he can be a registered director, he or she, right? Okay, so that's obviously is no problem. Only an independent director cannot be an executive officer of the company, right? A public company has this under Korean Commercial Code. A public company must have certain number of independent directors who are independent. So as to kind of minimize the kind of misuses, you know, abuses that could come from if that guy receives money from the company. Obviously, he has a hard time judging when it is required to make the review and say yes or no and vote. That will influence, right, his decision, obviously, the well-being of his position and title, okay, and continuing of his thing and advancement, etc., etc. So that's why a public company, since it's a public company traded, and there are many small investors buying and selling the shares as a method of investment, it requires certain type of transparency in governance. And they have that kind of requirement. But, well, that's a director other than a director usually, unless he's an independent 사회이사, right, can be appointed for the position of another senior officer. No problem. Is there any legal distinction between executive directors and non-executive directors? What's an executive director and non-executive director? Well, executive director means having some kind of position within the company, right? In the executive position. And non-executive director are just directors who are not executives of that company. But that may not be a legal distinction, okay? Here, under Korean law, we have basically inside director, outside director. Inside director means 사내이사, outside director means 사회이사, and non-standing directors. Okay, three type of director, but they are not crystal clearly cut. Well, what's inside? What's outside? Okay, do they have to be standing? Non-standing means full time versus not full time, right? So, well, anyway, that's how the Korean Commercial Code divides the directors, okay? So, but we are not going to go into the details. Non-standing directors, inside directors, but not involved in daily affairs of the company, usually. That's how they are classified. So the Korean Commercial Code, they categorize directors first into inside and outside, and then further categorize inside directors into ordinary inside directors who engage in the daily affairs of the company, and non-standing directors who do not engage in the daily affairs of the company. Okay? But anyway, that may be a bar exam question. Not for this class. Well, but you can take a look at the Korean Commercial Code and one of those many study books, commentaries on the Korean Commercial Code, and then find this out. It's very simple, right? Outside directors, something like independent directors under U.S. corporate law, they need to maintain their independence from the management, right? And certain requirement needs to be met in order to qualify as one. And the Korean Commercial Code gives you a qualification, right? They list some of the qualifications, which I am not going to repeat, but I think that's something that you could find out if you are interested later on, right? So all directors, in usual cases of this closed company, not a public company, private company, all directors are inside directors, okay? Whether they are standing or non-standing. So in this company, you don't need to have somebody who is totally independent. So all directors will basically be appointed by each shareholder. Here is the foreign shareholder, and here's the domestic shareholder, and they will kind of appoint their, existing somebody from here to be the directors of here. So they are basically all inside directors, all right? They may be, depending on how committed they are, they might be full-time working executive director. They may be just remain a director only and attend the board meeting, right? But that's how usually in the JV structure works. Unless you go to public and you have to have outside directors. Okay. Now, what's another question? Is there any? What are the duties and responsibilities of the directors? Right? Isn't this like bar exam question? What's the duties and responsibilities of the directors? Basically, the directors they have fiduciary duties. All right, meaning, they owe to the company a fiduciary duty. Fiduciary duty has a duty of care and duty of loyalty and things of that sort. They should seek the best interest of the company, and they should do the due kind of a care as fiduciary duty requires, right? And the directors together have a board of directors. They have the ultimate responsibility for management, right? All important matters need to be decided by the board. When something's not decided, then it's the board problem, right? Often there is an unclear gray line regarding what should be the board matter, okay? What matters, what should be decided by the board of directors? We simply call board of director BOD, right? What should be the board of director resolution item, okay? And what should be the shareholder item, for example, all right? And what should be decided by the representative director. Okay? These are kind of key questions in corporate governance, right? There are obviously statutorily required items. The Korean Commercial Code mandates you that this item needs a board of director approval, right? And this item requires a shareholder approval, right? And then also here, they have a special resolution and ordinary resolution, right? Supermajority, I said, and ordinary, right? And certain item require supermajority special resolution of shareholders. Certain item only, the rest of the items only requires ordinary resolution. Okay? The board too, there are something that requires a supermajority and ordinary, but this supermajority is very small. Something that have to do with a conflict of interest situation of the director, right? Corporate opportunity and things of that sort. When one takes an opportunity, wants to do something, but then, whether I could take it without first giving it to the company, in line of its work, he has this investment opportunity, whether he could just invest it, or first you have to ask the company and get the board approval, supermajority board approval in order to be able for him to do. So usually those items got to do with those kind of director conflict of interest situation. Rest of it usually is just ordinary board resolution. There's a clear distinction for that. And what about RD then? What is RD? What can he decide? Something in the ordinary course of business, which ordinary course of business is an important word. Okay. Something in the ordinary course of business. Well, in Korean it may be like 통상적인 업무, right? Of daily occurrences. Okay. But as you can see, the boundaries are not clear unless it's statutorily required. Outside of statutory requirement, BOD have this, important matters need to be decided by the board. But what are important matters? What's outside of ordinary course of business, right? And oftentimes, what is important and not important may be decided by the amount of the transaction, amount of consideration or obligation that is involved in that particular stuff, right? Right? So obviously, it's not very clear. That is why the chunk of the joint venture agreement, you go into this corporate governance section, got to deal with, what items will require shareholder approval, what item will require board approval, and what item will require, the RD can take care of by himself or herself, okay? In order to be clear, you need to you have to list, clearly delineate the boundaries of what requires, all right? So that is the reason why, if you take a look at the last items, you have this kind of a list called Annex 1 of what I have passed to you. The last 3 pages, right? Annex 1 is the matter requiring board resolution under the Korean Commercial Code, right? It just lists those items that the Korean Commercial Code specifically states. Number 1, approval of share transfer. Approval of share transfer. What does that mean? Why, if a shareholder wants to transfer the shares, does it require an approval? Okay, of the board? It does not. It does not by default. But only if the articles specifies that any transfer of shares requires a board approval. This is oftentimes used, as I explained before, as a means to restrict the transferability of the shares. The reason why I entered into shareholders agreement is because I am entering into with you. I'm not entering into with somebody else, okay? I mean, my investment decisions and everything is because I am in consideration that you will be my joint venture partner, not somebody else. That is the reason why they want to restrict the transferability of shares. Transferability is a fundamental characteristics of shares. Do you understand? What do you mean by share? Stock, okay? Fundamental characteristic of a stock is transferability. Okay? It's one of the fundamental characteristics of stock. That is the reason why if you prohibit fundamentally, right? By contract, you prohibit the transferability, but nonetheless, this guy transfers in breach of the contract, then the purchaser who purchases it in bona fide purchaser of the shares, okay? He said, what do you mean? I mean, I have the share certificates here. I purchased it. Okay? What does that mean? I cannot be owner of this stock? All right? So, there is, in joint venture agreement, there is this nobody. They have agreed. One cannot transfer its shares without the consent of the other party. Very simple, and very simple but powerful kind of a provision. Well, between A and B, A transfers to C in breach of this contract. C purchases in good faith. He pays the money, obviously. What happens? What happens? If the C claims that now, okay, asking the company to list me on the shareholder register, 주주명부, okay, is company obligated, is company bound to list him as shareholder? Or is company, let's say in this JV agreement, okay, in the joint venture agreement, company is also a party, let's say. Okay? So the company knows that there is such a shareholder agreement. Okay? What does the company should do in this case? Deny? Who has the right? Well, the law states is this. The transferability of shares is something fundamental. It cannot be taken away by private agreement. Therefore, if C purchased it in good faith, C will be the recognized shareholder, and the company should recognize and what? Making him a shareholder. Because share is transferred by possession of the share certificate, according to the KCC. Korean rule is that, share is transferred by the transfer. The possession of the share certificate. But between A and B, since A breached, B can sue for damages. Okay, if he incurs damages, then he can sue for breach of contract. But these shares are transferred validly to bona fide third purchaser. In order to prevent this kind of situation, what can you do? Because no matter what the contract states, still the law recognizes this, right? What can company do? What can the parties do? The only way practically possible to prevent the situation is to say the share in the article, you amend the article and include in the article this provision says that every share transfer requires the board approval, right? It's 3352, okay? It's Article 3352, okay? Why then does Korean Commercial Code recognizes this board approval stuff? Because under Korean Commercial Code, if board does not approve, after a certain period, this guy can demand the board to find an alternative. Right? There is that mechanism. So ultimately, the share is transferable, but the board kind of decides of whether it should go to this guy or that guy, right? But this is the effective way of preventing a kind of a transfer of shares by the shareholders in breach, and is frequently used, okay? So if the article states, then the board approves the share transfer. All right, this is a board item. Some of the board item can be transferred, to shareholder item by specifically stating what is an example of something that can be transferred to the shareholder. For example, appointment of representative director. That's a board item, okay? Among the director, they appoint the representative director, but the KCC specifically states that it can be moved to the shareholder resolution item. Other than that, unless those KCC clearly mentions it, it is unclear whether if it's a board item, you can transfer it to the shareholder and things of that sort. It's often not very clear. All right. So in order to find out, you need to read several of those good, like Lee Chul-sung or what's his name, right? All these like famously known professors written commentary about the Korean Commercial Code, and sometimes they differ. Okay, they have their reasons. Unless the court kind of decides, that matter remains uncertain, and you have to say so in your opinion. Anyway, what's another item? Cancellation of stock option to acquire shares. Convening a shareholder meeting. And now obviously this cannot, we do not think that convening of a shareholder meeting can be transferred to shareholders. This is a unique board item, okay? Election of the representative director. But it says may also be made by shareholder resolution, if so, provided in the AOI, right? Disposal and transfer of material assets, large borrowings, appointment and dismissal of managers, described in Article 10 of KCC. That's appointment and dismissal of managers described in Article 10. Establishment, relocation, and closing of a branch. Yeah, establishment, relocation, closing of a branch, it can be made a shareholder item. But notice this, disposal and transfer of material asset. What is a material asset? What's a large borrowing? Often this is not very clear, right? That is why it's good to have a specific threshold put in. You understand? Approval of competing transaction and dual position of a director and exercise of intervention right in competing transaction. Now this kind of thing is obviously you can detect a kind of a director conflict of interest situation. So this is probably a supermajority item. You need to be sure, you need to check, but it looks like one. Article, approval of a director's use of business opportunity of the company. Again, this is another one of those conflict item. In this case, approval of 2/3 or more of directors is required, right? It specifically states so. So obviously the one above may not be. I'm not sure. You have to check. Approval of transaction between directors and the company, okay? Why? Because it could lead to abuse easily, right? So 2/3 or more of directors is required. Decision to issue new shares. Now this can be a shareholder item. Transfer of reserve to capital. Change, okay? So this is also a shareholder item, could be made. Intermediate dividend, 중간배당, issuance of bonds, issuance of convertible bonds, bonds with warrant, etc. can be made a shareholder resolution item, okay? But anyway, these are statutory items reserved for the board, all right? And then, if you turn to the next page, there is what you call ordinary resolution and special resolution of shareholders. Appointment of a director or statutory auditor. Obviously, directors and statutory auditors are appointed by the shareholders, right? Statutory auditor, the function of the statutory auditor is to audit, to monitor where directors are carrying out their duties. They are appointing directors, also shareholders, but at the same time they are appointing somebody who can check and balance, right? It's usually monitoring. So that's why a director cannot be a statutory director at the same time, right? Because self-monitoring does not sound that optimistic, right? A determination of remuneration of director, okay? Since they are appointing directors, you have to set, how much they are getting paid. Again, why is this a shareholder item? Because if it is left to directors, okay, directors deciding how much they could get could be self-serving, right? That is why. Approval of annual financial statements. This one can become a board item if AOI specifically provides. Decrease of reserve, cash dividend, okay? Declaration of cash dividend shall be made by board resolution in cases where the board approves, financial statement as provided in the AOI. Meaning that if AOI states that board has the approval rights for the financial statement, then it also needs to be made a board resolution. Declaration of stock dividends. Why? Because it's something that stockholders get. Dismissal of a liquidator, completion of liquidation. So these are ordinary resolution items. Special resolution items are the removal of director or auditor. Okay, obviously removal needs more. Okay. Transfer, takeover, lease of the entire business, amendment of the AOI. Amendment of the AOI is very important. Okay, it requires special resolution. Merger, something fundamental. Dissolution, 감자, reduction in paid-in capital. Spin-off. 분할, right? Spin-off for the purpose of consolidation and all this little bitty of spin-offs, right? Requires a special resolution of the shareholder. All this fundamental like change, comprehensive share exchange, okay? Acquisition of treasury stock, meaning that a company buys the stock, all right? Granting a stock option. Stock split, issuance of shares below par value, if there's a par value, okay? Issuance of convertible bond with warrant. Think about it. Issuance of convertible bond with warrant, it all affects the shareholders' rights. Convertible bond affects it because once the bonds are converted into shares, right, then it dilutes, isn't it? It dilutes shareholders' shareholding, right? So it's bond with warrants. Bond with warrants means bonds has warrant. Warrant is just the right to purchase the shares at a given set amount, right? And in order to sell their bonds, they also issue bond with warrant, and warrant can be sold, right? But once somebody, bondholder with warrant, exercises their warrant right to purchase the shares at agreed upon amount, okay, then obviously it dilutes the shareholder. That is why issuance of bond with warrant requires a special resolution of the shareholders. Something also requires unanimous vote of shareholders. That's changing of stock corporation from 주식회사 to 유한회사, but not the other way. The other way, obviously, you cannot require shareholders because it's from 유한회사 to 주식회사. You need a members' resolution, not shareholders, right? Discharge of liability of directors, statutory auditor. The liabilities, they can be personally liable if they breach their duties, right? They could be personally liable, not just liable. The directors are they could be personally liable if they breach their duty. In order to waive their liabilities, then you need unanimous vote of the shareholders, right? Now, discharge of promoter liabilities, similar thing. So in order to waive, okay, those liabilities, it requires a unanimous resolution. So those are the good things that you should know. But anyway, as you say, these items could be made a shareholder item, right? A lot of the bold items could be made to the shareholder resolution item if they prefer to do so. Okay? But these are the basic mechanism. So, but line between bold and RD is not so clear because it has to decide all the important matters. But unless you have a clear rule of what requires a bold resolution, what can RD do, right? So that is the reason why you need to delineate what can RD do. If you turn a one page ahead of, a couple of pages ahead of it, this is a so-called minority shareholder veto right. Okay? Minority shareholder veto right, meaning I can understand 50-50. In a 50-50, you have the equal number of the board. The shares are owned equally. What's the ordinary resolution? It's a majority. Okay, majority of those present. Okay, it's a majority of those present at the meeting, but which is also at least 1/3. Special is not majority. 2/3 of those who are present, which should be which is 1/4 here of total outstanding. This is 1/3. 2/3 of those who are present, but whatever that vote is, satisfying this 2/3 of the present requirement should be at least 1/3 of the total issued and outstanding. Obviously, in this two shareholder situation, they will be represented at the shareholder meeting. So all the shares will be present, right? So this means a majority. So nobody can really decide if both of them are present. Right? No shareholder decision can be decided. And they will most likely, okay, appoint equal number of board. And what's the board rule? How should this be taken? It's a majority of incumbent directors. Okay? A usual rule, a default rule is there should be a majority present, meaning that if there's a 4-member board, 1, 2, 3, 4, at least 3 has to be present in order to meet the satisfactory quorum. Okay, quorum satisfied, and they vote. When they vote, it has to be a majority of these guys present, meaning that at least 2 in this situation must agree. If all of the 4 are present, right, majority means 3. Right? That's how the board resolution is being done. But as I said, even though you can have a board meeting easily because you can just take participation through conference. You don't even require Skype or some kind of audio-video conference. You only requires a teleconference, meaning the simultaneous audio transmission where you can hear the other guys, right, simultaneously. So, however, this guy can become seriously ill or something, and you cannot delegate your kind of, you cannot give power of attorney to somebody, to my wife, say, be present. Why? Because you have a personal fiduciary duty to make the business judgment, and that person may not be. Shareholders appointed you to be the director, not somebody else. Okay? So that is the reason why they usually strengthen, right? Strengthen the board requirement. All right? But there's a limit under Korean law of how far you can strengthen this board requirement. Right? You can say at least 2/3 of all the members should be present to satisfy a quorum. Right? You can probably do that and say the board, or regardless of the quorum, it has to be, all the resolutions should be adopted by the 2/3 or even 3/4. Something like that, okay? You can do that, but asking unanimous board vote for every board item is very, very likely to be held invalid. Why? Because it gives each member of the board a veto right. Right? So, that is not how governance should work. Because then if one just vetoes, then, okay, nothing can be done. Nothing can be done, right? So that would not be a good way of running a company, because this guy just say, forget it. I'm going to the McDonald's today and not attending. Ding dong dang, all right? No board resolution can be taken. All right? So that creates a very difficulty. So you can strengthen it, but up to a certain limit. But that limit is not crystallized. You have to decide by case. But in any case, between BOD, but in any case, if you don't have this 50-50 structure, you have, let's say, 70-30 structure. At least this guy who has 30% says, I need to have some kind of right to say no to something fundamentally important, right? Something important. And what are those important items? That depends on how people agree, how these two shareholders agree, okay? So all these items will require your consent, right? And what are those items? Well, for example, I don't want to be squeezed out, right? So if you issue new shares to third party, I don't want that, okay? Issuing shares, if you have more money than I do, so you can just increase the capital, and I will not be able to participate even if I want to, right? And therefore you only ended up participating, your shares increased to 70 to 75%, 80, and then finally you can squeeze me out even, right? So what can this 30% do, right, in order to protect its rights? So that's just showing you some of the examples of those veto rights that you can just spell out in the agreement, right? Approval and modification of the business plan. Annual budget. These are all important. If you lose those rights, then obviously you have no say, because the other guy decides the business plan, the other guy decides annual budget, things of that sort. Approval of audited financial statement. Now, think about it. Audited financial statement, as I said, it's ordinary, right? We just learned that it's an ordinary shareholder meeting, meaning that all these guys participate. What's required? A majority, 50% plus one share. So that means this guy can approve even though he says no, right? So when he has leverage, when this kind of a joint venture is created, when one has leverage and this guy needs this one, right? That is the time when he lists out the things that needs my consent. Okay. Now, approval of a transaction with a related party. For example, this guy just transact with a company. We decide to transact. I supply, you buy, or you supply, or I buy. It can easily be self-serving, isn't it? Even though we got fair trade law and everything, right? So, hey, don't do that unless I approve, If you enter into a related party transaction, should be, or this guy has another affiliate, and asks this guy to enter into agreement with his company, right? Or things of that sort. Alliance, joint venture, partnership, these are often, not ordinary course of business. You don't enter into alliance, joint venture, and partnership in ordinary course of business, right? This is something special. I mean, it needs to be defined. It may need to be, kind of a threshold needs to be put in or whatever, but anyway, usually requires my consent, the minority's consent. Now, share issuances, very important, right? Because, why? Because you got preemptive right, isn't it? Preemptive right to subscribe to pro rata in proportion to your shareholding. But however, that's not good enough. I may not have the money to subscribe, right? So I want that kind of a situation to be controlled. Subsidiaries, meaning creating a subsidiary underneath, branch, commencement, defense, settlement of litigation, arbitration, exceeding certain amount. The minor ones you don't want to bother with. Some major ones, okay, I need my voice in. Corporate guarantee, if you guarantee something. Guarantee is always, out of ordinary. We got it. Now, financing indebtedness above certain amount, right? Incurring liability above certain amount. Entering into any agreement with a term of 1 year and payment obligation in excess. Okay, usually if you say a longer term is 1 year or more, and then also the amount is important, right? With a minimum amount of X or above is so-called material contract. Now, why am I suddenly covering this item? Because these are very similar items that you can put in here as to differentiate what should be RD and what should be the board decision, right? Some of the things like business plan obviously requires the board approval, right? But when you go into expenditures, borrowings, etc., you have to decide what is a daily ordinary course of business that this guy should take care of instead of coming to board to decide everything. I'm entering into a kind of agreement with a janitoring service to clean the apartment and clean the office and so on. The amount is very small. Then it'll be efficient for this RD to just decide, right? And RD could even delegate his authority to another officer if it's a very small amount, right? That is why these kind of things from A to Z, how convenient, right? Can be used to specify what the role of the RD and what the role of the BOD. You just specify the specific amount, right? In this way, I think there's a transparency. RD would know what matters that he can decide and what matter he should ask the board to decide and so on, right? So, okay. So, material contract, okay, entering into a material contract, incurring capital expenditure or any significant expenses. Again, this is a monetary threshold. How about disposing of assets? You sell some of the assets. Of course, you are getting more cash or something in return. However, still, decision to sell off some kind of asset, even though you receive consideration of greater than certain amount, requires my vote. This can apply here, also. Creation of mortgages, security interests, some kind of 담보, exceeding certain amount needs also, obviously, requires my voice, other than it has already approved in the business plan or annual budget. Sure, because annual budget and business plan approval requires my consent. Okay, once it is consented, then it's described, then you don't need no second consent. Appointing, removing, or changing the RD or other member of the management term. Okay, this specifically is under this situation because here RD cannot. Approval of the RD is usually board item, right? Management team needs to be defined, but it talks about executive management team such as COO, CFO, and all sorts of like sales director, marketing director, those important items, the director level items, right? Creation of any committee of board of directors or delegation or withdrawal of any power of board of directors. So that's under this situation. Adoption, alteration, amendment, or repeal of major internal regulation of the company, obviously, So what he's saying is that in this situation of 70-30, you can change it by adopting regulations approved by the board, but I don't want that because you already have the control of the board, okay? Because board is by majority. So that's why I want, if this kind of item happens, then existing system could change and you could gain more control, and therefore it has to be approved by me, kind of a thing. Selection and changes in the accounting firm is important. Accounting firm is the external auditor, right? External auditor. So it has some kind of effect. When you change that, you need my consent. establishment of tax practices, any changes thereto in compliance, any material changes thereto in compliance with applicable law. So if you change your existing tax practices or any material change thereto, material, notice, okay, requires my consent. Acquisition or disposal of any equity or securities convertible into equity of any person. But again, you know, it's almost the same thing as issuing equity, right? Shares, ownership. If you issue a debt securities convertible into ownership. Dividend policy change is something very important. Change in the name. Obviously, this is a change in the name of the company. It's automatically, if you want to change the name of the company, you have to do what? You have to amend the articles. And articles of incorporation is what? Is what? It's a special resolution item. Okay? However, what's the special resolution item? 2/3. What's 2/3? If you have 66, you can control. This guy has 70, right? So even if you have 30, you have no control on that item. So that's why he puts this in, right? Okay, that's C. So that gives you some kind of example, not 100% corresponding, but usually those expenditures in the amount of what, the lease, guarantee, material contract, all those kind of things, you can define it to make it specific that which one is the bold item and which one can go to RD, right? Okay, so that's how you usually do. Okay, done. And what I want to do is I just want to continue until 211 because we don't have many left. And then 3 and 4 we don't need to cover here. So we will today just continue until 211. And then next week we just want to go through this agreement with you so that you kind of have a glimpse of what a typical joint venture, simple joint venture agreement is like. Okay?